Welcome back. We will now address our third learning objective for this week's topic, which is to classify transactions and account balances into financial statement cycles and understand why audits are performed on cycles. Although the audit opinion is given for the financial report as a whole, in order to actually conduct the auditor has to disaggregate or break up the financial report into its component parts. That is, the underlying account balances and transactions classes that are summarised in the financial report. These balances and transactions are grouped together in financial statement cycles. So, audits are performed by dividing the financial statements into smaller components. This makes the audit more manageable and efficient, as different components and tasks can be assigned to different members of the audit team. It is also an efficient way of auditing because you're auditing closely related transactions classes and account balances. So the audit process reflects the flow of accounting entries from the transactions to the general ledger accounts, from the transactions to the journals to the general ledger accounts. These accounting entries are the record in the accounting information system that reflect the underlying business processes of the entity, as you have learned in IPC. As we will see in future classes, it is very important that the auditor understands how these business processes are reflected in the accounting information system, and the auditor understands the controls over the processing of the transactions because that affects the quality of the information. The key cycles for a generic entity are the sales and collection or revenue cycle, which is where the entity sells its goods and services and then collects the cash in payment for those goods and services. The mirror of this is the expenses or acquisitions and payments cycle, where the entity acquires and pays for its inputs. One specific input is the cost of labour. In most businesses, payroll is a separate functional area and hence is a separate cycle for accounting purposes and auditing purposes. The inventory and warehousing area is also regarded as a separate functional area, although of course it is interrelated with the revenue and expenses cycles, as goods increase inventory when they are purchased and decrease inventory when they are sold. The first four cycles deal with an entity's operating revenues and expenses. The final cycle, capital acquisition and repayment, as the name indicates, deals with the acquiring and financing of non-current assets. This diagram, which reproduces figure 4.5 from your textbook, Aaron's, shows how the transaction cycles are interrelated with each other. Two important points to note. One is the critical importance of cash. Cash flows really are the lifeblood of the business, as the saying goes, and you can see that cash transactions are related to all other transaction cycles. The second point is that the interrelationship of the cycles, which reflects the nature of the double entry accounting system, reflecting the underlying business processes, enables efficiencies in the conduct of the audit. Although the cycles are audited separately, we can share audit evidence that we collect in order to avoid duplication and make our audit more timely and efficient. Finally, this table 4.1 from Aaron's shows the transaction cycles as they apply to a hypothetical company. For each transaction cycle, down the left-hand column, you can see the relevant journals and then the relevant general ledger balances, which may be either balance sheet accounts or income statement accounts. In our next video, we will see how the auditor further breaks down the account balances and transactions classes into their component parts in order to perform the audit.